What's going on, guys? Bexio, and today we get a brand new video with Jerome Powell trying to crash the market. They came out saying the Fed has an emergency meeting that's coming the 14th to talk about rates, and maybe the market freaks out a little bit too much over this news, but it's completely catching the market off guard because no one was expecting a meeting to be coming in on the 14th, and regardless, a meeting to raise interest rates in February. All of that was expected to happen in March. But before we get into that, if you are not subscribed, make sure to smash that sub button because we're on the road to 1,000 subscribers. But let's take a look at this Fed meeting here. We got it right here, them calling the closed board meeting. So it's not going to be like a press conference or anything like that. And this part right here is review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve Bank. So basically, interest rates. So they'll be talking about interest rates or doing rate hikes, which obviously the market was not expecting, was not pricing in, catches it off guard. The one thing the stock market, all markets hate the most is being caught off guard and having uncertainty over a situation. And that is exactly what we have with this types of stuff here. Emergency meeting could be increasing rate hikes way earlier than what people were expecting, and could even be doing it worse or more harsh than people were expecting as well. Obviously, you see the markets and indices, the Dow Jones down 1.5%, S&P down almost 2%, the Nasdaq down almost 3%, and the Russell 2K actually doing pretty good, only down 1.02%. So market volatility obviously skyrocketing, and in times like this, a good way to kind of see that people are going really risk off, going into more secure types of investment things. You can go to the oil and see oil is on a heavy rise. So commodities start to get where the money flows instead of assets and risk assets and stuff. And even with the price of gold, you can see this is gold and silver. You see these little rallies here because everyone goes back into the commodities market. So we see all of the indexes down, the VIX, the volatility up, and commodities up as well. And this is what people were worried about, was the Federal Reserve raising rates. They were expecting it in March. Obviously, we could get it earlier now. And then on top of that, a 50 basis point, basically that's 0.5%. And that would be a little bit higher than I think a lot of people were expecting. But the problem is still with CPI that came out. We saw the CPI numbers. They were very bad, 7.5%, worse than expected numbers. And we all know those numbers are understated. Those numbers are not real inflation, where we see obviously like big ticket things like rent is up way higher than what they have in CPI. Energy is up insanely high, and that's even in the CPI and reported there. And it looks like it's kind of somehow manipulated to look that way. But we all pretty much know the CPI is understating inflation. Inflation is a lot higher than what CPI is talking about. So you see people like Citibank talking about, the Federal Reserve to take a more aggressive 50 basis point instead of the 25 right here, 25 basis point they were kind of expecting for next month. Now they doubled it to a 50 basis point, and saying they don't even say it could be coming right now. They still have it in March, but it could come now in February, freaking out all the markets and stuff. So just, even at these rates of increase, it's still a problem where they can't increase it enough to really combat inflation. So we can see that on this right here, this chart right here. So we have the federal funds rate at 0.08% right now, and a massive gap between that and the inflation of 7.5% that just came out the other day. And if they upped it to 0.5%, I mean, that's not going to move anything. Even after, if they do 50 basis points, so 0.5% increases, they do that 4 times. That would be in the next year. Next year, we'd be at about 2% for the federal funds rate. And let's even say just 2.5, just to make, you can see this line here. So we'd be right here, and inflation, it's still nowhere near the 7.5 inflation that we have right now. So it's not combating this. To try and combat it, you probably have to get pretty close, if not over the 7.5 mark. You'd have to be at 8% for the interest rate so that you can drive inflation down. But in doing that, could very easily drive the economy into a recession and just get really bad things happening. So Jerome Powell does not have a job that I think anybody envies or would want to be in that position. He's basically the bad guy either way. Either he increases interest rates enough to crash the stock market and financial markets, but not really combat inflation, or he raises it enough to combat inflation, but plunges everything into a recession, and that could make things even more worse. So he doesn't really have a great option here on which way to kind of go. But in talking about investing with these rate hikes, obviously the whole market and everybody worried about rate hikes, worried about, crashing the markets and things, and could be worried about that. But with interest rates, doesn't correlate to a bad performing economy. We've had obviously interest rates at 2% for a long time, and the economy did fine. But if you look even historically, we can see right here that the stock market performs pretty good even with interest rate hikes. So this is 6 rate hike cycles, and you can see they go over different time periods for all of these types of things. But even like right here, you see 95 to 97, so 2 years. The Dow Jones up 50%, S&P up 44, NASDAQ up 31. And that was with rates increasing. So the stock market performed very well with rates increasing. You see it, a lot more green than there is red. There's only 2 reds in here. And it's basically the 2007, 2008 financial crisis. And after this kind of dot-com bubble stuff. So very insane recessionary things happening with pretty big kind of catalyst going on with the housing market collapse and the dot-com bubble collapse. And then you look at the other ones, which we might be closer to in like a normal trading type way where there's nothing crazy that's happened that looks like, dot-com bubble or housing market crash, but maybe something could come out. But even if you look at this, of the last 6 rate increase periods, we see 1, 2, 3, 4 of them are green, 2 of them are red. So basically, 2/3 of the time, the stock market performs good, and it performs even really good, like 50% gains for the S&P, the Nasdaq 78, 51, 81. So things are still performing really, really good, even though people want to be so scared of rate hikes and all this kinds of stuff. So for one, I don't think that the Fed will increase rates at like such a ridiculous amount. Like they'll go from, we're at 0 now to 8% in a month. They might go up from 0 to 0.5%, and then the next meeting go up another 0.5% to 1%, and then to 1.5%. They're going to do it gradually, if they're even going to go that high, and it's just going to be over a long period of time. So it's not going to be as bad as kind of the market's thinking. And obviously, we all know the stock market always overreacts to every situation. And that's just how human nature goes in trading. So the stock market, if something good happens, it'll price it as great. If something bad happens, it'll price it as terrible and the worst thing possible. So it usually overswings, and it always usually comes back around the other side, and it just takes time to do that. And I think people are overreacting a bit at the interest rate hikes dilemma and the fear there, because we see historically it doesn't really matter. So the one thing you can do from all of this is not try and time the market, not try and buy the bottom, because if you miss the rally, then it becomes a big problem. You might as well ride it out, maybe even buy the dip. But historically, we see nothing to really be worried about and freaking out about. And no matter what they do, they're more than likely not going to have a ridiculous increase where they go up even a whole percent in a meeting. I don't see them trying to do that. So They'll do it slowly. It'll take a long period of time, and it probably won't do anything against inflation. Depending on if they can try and do it at enough, get the interest rate enough high enough to try and start bringing inflation down, and then start seeing supply chains kind of get better and everything just start to get better, and it might come down naturally instead of the interest rate stuff. But only time will tell what's actually going to happen with all of these decisions from the Fed. So we'll wait until the 14th in 2 days to see what this meeting is about. If something actually happens, we probably won't even get news from it because it is a closed door meeting. It's behind doors, and we'll only get to hear about it in their next meeting to see if they're actually going to increase rates earlier and do it more harsh than what they were planning on doing before. But as always, that's going to do it for this video. Don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next video.